In this video, we will consider whether or not a manufacturer should accept a one-time special order of additional business. Assume that Ellison Enterprises manufactures headphones. We are given the income statement for the year ended December 31st, 2021, when 10,000 units were sold. Ellison Enterprises has received a request from a customer to sell 1,000 units at $90 per unit. The customer has asked the company to add their logo to each set of headphones, which will cost Ellison Enterprises an additional $10 per unit in variable costs. We also know that the cost of goods sold is 40% fixed and that the operating expenses are 30% fixed. Assume that Ellison Enterprises operates at well below capacity and they are easily able to handle the production of the additional 1,000 units. The question is, should Ellison Enterprises take on the special order? To answer this question, we must complete a special order analysis based on the relevant costs and revenues. What do I mean by relevant costs and revenues? I mean only the costs and revenues that will change as a result of accepting this special order. So first we have the sales, which are said to be $90 per unit for the special order. This is relevant as each of the 1,000 units sold will bring in an additional $90 in sales revenue. Next we have the cost of goods sold, but we are only interested in the variable part of the cost of goods sold. We are told that 40% of the $800,000 of cost of goods sold is fixed, meaning that the variable portion must be 60%, since the fixed and variable components together must add to 100%. 60% of the $800,000 cost of goods sold is equal to $480,000. The per unit variable cost of goods sold is $480,000 divided by the 10,000 units sold, which equals $48 per unit. We can use the same process to find the variable operating expenses. 30% of the $200,000 of operating expenses are fixed, so these costs won't change when more units are produced. If 30% of the operating expenses are fixed, that means that 70% are variable. 70% of the $200,000 of operating expenses is $140,000. The per unit variable operating expenses are $140,000 divided by the 10,000 units sold, which equals $14 per unit. Also, remember that there is an additional $10 of variable costs associated with this special order, which we must include. Totaling all the variable costs up, we get $72. We can find the contribution margin per unit, which is just the sales minus the variable costs. So we have 90 minus 72, which equals $18 of contribution margin per unit. Remember, the contribution margin per unit is the additional profit brought to the company when one additional unit is sold. Since the special order is for 1,000 units, we can multiply 18 by 1,000 to get the additional profit earned from the special order, which is $18,000. So in conclusion, it is worth it for the company to take on the special order. Each of the 1,000 units will generate $18 in profit, making for $18,000 of total profit for the order. Now, there are a few things to be cautious about or to consider when you are offered a special order. First is the question of if the special order really is a one-time order. If not, the company may have to ask if it makes sense to offer a lower selling price on a long-term basis to this customer. In our example, the special order selling price was $90, but the regular selling price is $110. Is it fair and sustainable for the company to offer a discounted price to this customer on a regular basis? We should also consider if accepting this order will have any effect on existing sales. If for some reason accepting this order would have an effect on demand from other customers, we would need to factor that into our analysis. Alright, that wraps up our example relating to whether or not a manufacturer should accept a one-time special order of additional business.